Good morning. My name is Frank Grinnell. I've been advising professional money managers and investing in the stock market for over 20 years. It serves as my day job, but most importantly, it is my absolute passion. On Street Views, I offer my daily viewpoint on the stock market in under 7 minutes. I will cover things like the global macroeconomic picture, the mood of the market, company-specific news, secular trends with some actionable sector and stock calls. I hope my insights are useful to you, whether you are a professional money manager or a passionate investor. At Grinnell Capital, we actively manage dynamic stock and ETF models for financial professionals and their clients, as well as individual investors. If you want to learn more about what we do, send me a note, frank@grinnellcapital.com. You can also find more of my insights on Twitter @GrinnellFrank. And now, today's Street Views. Hey, good morning. It is Tuesday, the 22nd, week of Thanksgiving. We are traveling, so I'm actually outside. It's a little windy right now, so I apologize for the wind in the background, but futures up modestly this morning. Got a pullback in the dollar, and on trend with that. Bonds are up slightly. No big moves, really. The lesson from yesterday, don't trade on rumors unless it's the inverse move. Had a Wall Street Journal article about a potential production increase out of OPEC Plus sent crude and energy stocks reeling once Saudi came out and denied the move, suggested the move they would be considering in early 23 would actually be a further cut potentially. WTI recovered all of its losses, and stocks moved and recovered quite a bit themselves. Now, if you bought that dip, good for you. We were watching the action, not doing anything. Given how heavy crude's been acting, and I've been talking about this, we sort of stayed away. I want to see at least a day or two of consolidation and some kind of intent to resume an upward move. Up 2% this morning is nice. We've said many times of late, our preferred ways to play energy right now through oil service as well as inexpensive exploration and production companies, ones that are trading around 3 times EBITDA. There's actually quite a few of them out there. Real cheap, and it looks more like we're going to get a pretty cold winter here in the U.S. That would be very constructive for natural gas, given everything else going on too. Another commodity we're looking at here is copper. Everybody knows Dr. Copper and all that fun stuff associated with a relift coming out of recession, coming out of a decline in an economic cycle. Yesterday, with the strong dollar, watching copper stocks gap down, of course, in the morning, but they slowly recovered throughout the day. Watching Freeport-McMoRan, watching a copper ETF that I like to look at. Thought that was pretty constructive action. The eventual, China reopening, coupled with our Inflation Protection Act, so a lot of incentives coming out of the U.S. government for EVs, for infrastructure. We'll talk more about this as time goes on. But in this case, the copper play would obviously be more for, number one, the grid, but number two, EVs. I've heard from lots of folks that have done a lot of deep dives on the amount of available capacity globally when it comes to copper and the amount of ambitions there are out there for electric vehicles and the batteries. There simply isn't enough copper out there to meet that goal. Inventories currently are low globally right now. So it's a play that we're looking at, and the stocks and the action looks pretty constructive. Freeport closed below its 200-day yesterday, but it looks like it's going to gap up above it today. Stock acts really well. COPX is the copper mining ETF. That's an alternative that we look at. When we do play miners, one of the things we do like to do is take a look at the ETF. You could have issues with a given project, permitting, accidents with any one given company in the mining space, but the ETF significantly reduces that risk, and you do get the move. You might not get as much of the move as you might with a pure play like a Freeport, but you get plenty of upside playing an ETF in that situation. So something we're definitely thinking about. The macro sort of fits. You can argue that we're still looking at deceleration of growth here in the U.S., which I would agree with, but copper is much more of a global story, and I think it has a lot to do with levels of inventory right now and potential endpoints for that commodity, and the use of current capacity, I think, is looking pretty strong. So something to think about. Have an awesome Tuesday. Be back to you tomorrow.
And now for some important disclosures. Grinnell Capital is a state-registered investment advisor. Services offered by Grinnell Capital can only be offered in certain states where Grinnell Capital is registered or meets required exemptions. Registration does not imply a certain level of skill or training. For additional information about Grinnell Capital, including its services and fees, please review the firm's disclosure statement as set forth on Form ADV and available at no charge at advisorinfo.sec.gov. This podcast is provided for informational purposes only. The information contained herein should not be construed at the provision of personalized advice and is subject to change without notice. This material should not be considered as a solicitation to buy or sell any asset or engage in a particular investment strategy. Investing in securities involves the risk of loss, including loss of principal invested, and may not be suitable for all investors. Past performance is no guarantee of future results. This podcast contains certain forward-looking statements which indicate future possibilities. Actual results may differ materially from the expectations portrayed in such forward-looking statements. As such, there is no guarantee that any views and opinions expressed will come to pass. All expressions of opinion reflect the judgment of Grinnell Capital as of the date of publication and are subject to change without prior notice. This podcast contains information derived from third-party sources. Although we believe these sources to be reliable, we make no representations as to the accuracy of any information prepared by any unaffiliated third party incorporated herein and take no responsibility therefore. This podcast is provided with the understanding that Grinnell Capital is not engaging in rendering legal, accounting, or tax services, and we recommend that you seek out the services of professionals in these aforementioned areas. The principal investment focus of the accelerator model, the strategy, is to achieve strong relative and risk-adjusted returns, primarily by investing and trading in securities issued by companies that focus on the global information, technology, consumer, healthcare, industrial, and infrastructure sectors. These sectors are characterized by robust secular growth, an abundance of both new and maturing product cycles, a high degree of competition that creates the potential for relative winners and losers within a subsector or theme, a high degree of revenues and earnings volatility, rapidly changing sentiment and public perception, significant yet unrealized potential for globalization, and superior relative liquidity. Investment in the strategy is speculative and involves a high degree of risk. The second investment model is called the ignition model. The ignition model is an all-exchange-traded fund, ETF, strategy with investment objectives similar to the accelerator model. This model seeks to capitalize on long-term growth trends experienced by the market leaders in various areas and sectors. The ignition model will also seek ETF investments based on cyclical forces experienced in the U.S. and the global economy. This model is also designed to have the ability to offer some downside protection in the event of significant market stress through investments in ETFs designed to take advantage of market volatility. The strategy's performance can be volatile. Grinnell Capital has total trading authority over the strategy. The use of a single manager applying similar trading programs can mean a lack of diversification and consequently higher risk. For more important disclaimers, please visit our website, grinnellcapital.com.